Hi, Brian.
Hi, Paula.
Okay, so today on Things That Matter with Brian Batter. So I was talking to a client this past week, and they really wanted to get a better understanding of how we can distribute money tax-free. And I really appreciate that you helped me talk through some scenarios and you answered some questions for me. And I just thought that this might be a really good topic that more people would want to better understand. So could you walk me through like this idea of generating money or receiving money tax-free?
Yeah, sure. Well, first things first, a couple of ways to do it. The first is putting your money into something that will throw off tax-free income, like a municipal bond, right? That's you go to New York State, you go to the state you live in, the county you live in, and you buy a bond. The interest that that bond pays you is non-income taxable. Government bonds, federal bonds can be federally income tax free. Now that's the product per se that you can purchase, you can invest in that will generate income tax free money or yield. Then you have accounts that are registered as tax free, like anything that has the word Roth, ROTH, in front of it. You can have a Roth 401k or a Roth IRA. The difference between a 401k and an IRA, really simply, is IRA stands for individual retirement account. 401k is something that your company puts together. So the main differences between the two are that the Roth 401k is going to have much higher contribution limits than an IRA, a Roth IRA will, number one. Number two is that a Roth 401k will not have any income restrictions. Once you reach a certain threshold, whether you're single or married, with the Roth IRA, you're no longer able to put new money into that Roth IRA. So you might have one when you were below the income threshold, but once you cross over that income threshold with a Roth IRA, you can't put new money in. That is not there with the Roth 401k. So you can make a lot of income and put it into a Roth 401k at your job. Why does it come out tax-free? Well, because the money that you put into those accounts, the Roth IRA, Roth 401k, was already taxed, right? So we use this idea of the seed and the harvest, right? Most traditional IRAs or traditional 401ks or SEP IRAs, think pension plans, those accounts are funded with seeds, your money, seed money that has not been taxed. And so when you do your tax returns at the end of the year, whatever you contributed to your traditional IRA, your 401k at your job, your SEP IRA, if you're self-employed, that contribution to those accounts gets subtracted from your income, right? It's a write-off to you. So you didn't pay tax on those seeds that you invested in those tax-deferred accounts. And now when you take it out later, all of its income taxable, right? The Roth 401k and the Roth IRA are different in that you pay taxes on the seed money that you invest. And since you already paid taxes on the seeds, you get to take everything out later on, income tax free. So that's the main advantage of Roth 401k, Roth IRA. Now, another way to get income tax free money, and this is one that's kind of like the third rail in politics and even in the culture and the zeitgeist, is actually borrowing against assets that you own. We hear the media and politicians scream that the wealthy need to pay their fair share. Okay. The stats bear out that more than half of the income taxes paid in this country are paid by the top earners. So the wealthy are already paying a lot. That doesn't mean a corporation shouldn't pay more. That's a topic for a different conversation. But the big question comes up, well, why is it that we see Elon Musk or anyone individually, very, very wealthy people, they don't pay income taxes? Well, the simple reason is because they don't have income. They're able to use the assets that they own, whether it be real estate, whether it be a business, a publicly traded entity that they own. They're able to use that asset as collateral, and they get a loan against that collateral. And when you receive a loan, when you borrow money, you don't pay income taxes. You pay interest. And so the other day when that question came up, it's like, well, what's the scenario that this particular couple had? And they're like, well, they have some insurance policies. They're looking at utilizing insurance as a way to get tax-free money later on. So it's important that we understand how that works. And the best way to start is helping people understand that when you take equity out of your house, if you borrow that equity, that's called a cash out refinance, right? When you borrow that money, you're not paying income taxes on it. You pay interest on that money. So let's use just a simple example. You bought a house for $100,000. It increased in value to $500,000, and now you want to go do the backyard, put the deck in, the pool, the whole deal. Okay, well, there's two ways for you to get that money. The first way is sell the house. You bought it for 100, now it's worth 500. You could sell it. You could put $400,000 in your pocket. That's one way to get the money. But now you don't have the house. Right now it's somebody else's backyard. That's not what you want. It's your backyard. You want to redo it the way you like. So selling it isn't really an option. The second way is to go to a bank and say, hey, my house is worth, meaning it appraised for $500,000. I owe $100,000. I want $200,000 to go do the backyard, to do a thing, right? To redo the house, whatever. Now, in that scenario, the lender is going to be very excited to give you this money because they're going to give you a loan. Now, typically, just to kind of put some parentheses on this, when you do what's called a cash out refinance on your house, you're paying off the old mortgage that you have. So if you had a loan that still had $100,000 owed on it, and you went to this lender and you said, hey, my house appraised, it's worth $500,000, and I want to take $200,000 out to go do the work, that bank will give you one new loan for $300,000. Of that $300,000, $100,000 is going to pay off the old loan. So now you end up with one loan that has a balance of $300,000 that paid off your old loan of $100,000, leaving you $200,000 to go do whatever you want. That $200,000 that you just received is not income. So it won't be considered, it won't be income taxable, right? That's a way for people to use assets to generate tax-free money, right? Now, the second way a person can do that with their home is they can do what's called a home equity loan. And that's different than a cash out refinance. And the reason why it's relevant, because a lot of people get caught up with this. They're like, oh, wow, I saw my bank said I could take equity out and I can, and I don't have to pay off my old loan. They'll give me what's called a second loan, or they can just call it a home equity loan, in basic terms. But the reason why that can sometimes not be that advantageous is, the tax deductibility of your interest can be up in the air because usually the IRS wants you to only allows you to deduct the interest on what's called a purchase money loan, right? So if you get that second loan, that home equity loan, that's not purchase money. That's go redo the kitchen, the bathroom, the backyard loan.
Yeah.
Right. Now, if you pay off the first loan with your new cash out loan, that's still considered the purchase money. Right. So when people see that advertisement, that offer from their bank, oh, they're going to offer me a home equity loan or something called a home equity line of credit, a HELOC. Well, those inherently will charge higher rates of interest. They will still also be tax-free. Right? You're not going to pay taxes when you take that home equity loan or that home equity line of credit. You'll pay income taxes on that. The deductibility of the interest, so I'll leave that to your accountant to determine. But the idea here is you're going to get charged a higher rate of interest. And it's important that we understand that. Look, why am I going to pay higher interest rates if I do a home equity loan or a home equity line of credit? Well, flip the script around. Let's say you're the bank here, Paula, and I come to you and I say, hey, my house is worth $100. I'm sorry, my house is worth $500. I owe $100 on it, and I want to take some money out to go do a thing. Now, in your world, you're going to give me two choices. Hey, I can give you a cash out refinance, Brian, where you're going to pay off the old $100,000 loan and I'm going to give you a new loan for $300,000. You end up with one loan, $300,000 owed, right? And during the closing of that loan, the $100,000 loan gets paid off, right? It's not like I have to write a check for myself. That's done in what's called at the closing table, right? Now, if you do that and I don't pay the mortgage, I don't make my monthly payment, you can foreclose, right? You can take the house away. Now, if you give me the home equity loan or the home equity line of credit, that's not paying off the first mortgage. So now all of a sudden, you are not in first position, meaning you're not first in line to get paid if I don't make payments. So by definition, let's say, I owe the $100,000, you give me a $100,000 home equity loan. I don't pay either of them. Now all of a sudden you have to foreclose on me. Or maybe I'm just paying yours, the second mortgage, but I'm not paying the first one, the big one. Well, they're going to foreclose. Doesn't matter that I'm paying you. They're going to foreclose. And because they're in first position, when that ultimately gets sold, the courthouse steps or at auction or whatever it is, if that house sells for less than what's owed, again, let's say I had a $100,000 first loan, you gave me another $100,000, so I owe $200,000 on this house. And it drops in value from $500,000 and it only sells for $180,000. Well, the first position, the first loan gets the first $100,000. They get the first dib at the money, right? So they get paid off. You were owed $100,000, but there's only $80,000 left on the table. You're in second position. You get $80,000. You have to eat the $20,000 of loss. So because you're in second position, you're at higher risk of not getting paid back. That's why home equity loans, home equity lines of credit will charge higher interest rates than a cash out refinance. Both of them end up giving you income tax-free money. Because when you borrow your equity, you don't pay income taxes. You pay interest. Now, the same principle applies with life insurance. So if a person has a cash value life insurance, now that's not term insurance. Term insurance by definition is pure insurance. It's like your car insurance. It's like your cell phone insurance, right? You buy cell phone insurance in case one day you decide you're going to sweat olive oil and your phone's going to slip out of your hands and you didn't buy the OtterBox like I did, right? And you break your phone as it tests gravity on the way down, right? Well, you bought cell phone insurance in case. But if you decide, you know what, I'm not using a cell phone anymore. I'm going to go flip phone. I'm going to go, 2 cups and a string or whatever it is. They're not giving you your money back for the months or years that you paid that insurance premium on your cell phone that you never made a claim. They're not getting, your car insurance company doesn't give you your money back if you decide, I'm not going to I'm not going to drive a car anymore. I'm going to go buy a 10-speed and I'm going to go ride a bike to work and do stuff like that. So, hey, I paid for car insurance for 5-10 years. Why don't you refund me everything I paid you because I never made a claim? That's not going to happen. Term insurance is the exact same thing. A lot of people get misled with this or get confused by it because they hear of other people using money from their insurance policies. But term insurance in and of itself does not have any cash savings. The 2 types of insurance policies that will have cash value or cash savings are whole life, number 1, and then universal insurance, number 2. Now, in universal, you have a few different flavors. You have traditional universal, which is similar to whole life in that the insurance company tells you how much interest they're going to pay you. Kind of like your savings account at the bank. You get what you get and you can't really ask for more. I mean, I guess you could go ask for more, right? Like knock on the door of your bank, like, hey, I want more than this. They'll say, isn't that nice? Sorry, you get what you get. You don't get upset, right? Or if you do get upset, just don't tell us because we're not going to do a damn thing about it. So that's what's called a fixed rate of return. You can have what's called the traditional universal life policy. The main difference between a whole life and a universal is universal is going to be way more flexible than a whole life. Whole life is inflexible. It's the oldest form of life insurance that there is. That doesn't mean that it's bad. also doesn't mean that it's good. It just means that it's not going to adjust to your life's circumstances, the changing circumstances. Universal will. It can be adjustable. You might also see it advertised as adjustable life. That's universal. So the first way to earn interest in universal is fixed. The second way to earn interest in universal is through the stock market. It's called variable. Some whole life policies will do that as well, but you don't have the flexibility in it. Variable just means you're tracking the stock market in some way, shape, or form. And so you don't know what it's going to make for you if it goes up or what it's going to take from you if it goes down. The third type of universal is something that's become very popular in the past few decades. It's called indexed universal life. And what that means is that you're tracking stock market indices, like, popular ones like the NASDAQ or the S&P 500. And you're able to earn interest if the market does well in a given 12 months. Let's say, May to April, August to July, whatever it might be. If the index goes up, you can earn interest up to what's called a cap or a limit, some type of limit that's going to be placed on how much you can earn. Now, you might be asking, well, why would someone want to limit how much they could earn on the upside? In an index product, by limiting your upside, you're going to get an implied guarantee against loss on the downside. So you give up something in order to get something when it comes to this. Okay. Now, there's a provision in the IRS code. It's called Section 7702. And it governs distributions from cash value insurance policies. And so it's important that we understand that home equity example first before we try and digest how the heck you get tax-free money from an insurance policy. Because most of us are familiar with taking money out of a house, whether we've done it ourselves before, our family's done it, we've heard about people doing it. Right? It's something that's very common, taking equity from the house and doing the work on the house. Not as many people have understood how life insurance operates in the same way. Okay. Am I making sense so far?
You are.
I feel like it's like you just pulled a string, like I'm a little doll, and just
That's
keep
okay.
going.
We love it.
So when you have cash value inside of your insurance policy, you have two ways to get that money out. The first is simply withdrawing what you've got, right? Now, withdraw means you're just taking directly from the account. Now, there's two important words to understand before we dive any further, and those words are cost basis. It's an IRS term. It just means, how much did you put in? What did you spend on this? Right? If you bought real estate, you bought a stock, how much you paid for it? Well, that's called your cost basis. In the insurance policy world, the life insurance specifically, the premiums that you've paid in are your cost basis. And with life insurance, the money you're paying in is going to be already taxed. It came from your paycheck or your business income. You pay tax on that paycheck or your income. It lands into your checking account or wherever that might be. And then from there, you're paying into your insurance policy. So the money that's going into the insurance policies has already been taxed. It paid tax on the seeds, like a Roth IRA or Roth 401k. So if I withdraw from an insurance policy that has cash value, I can withdraw cost basis without any tax problems, any tax reporting, any tax liability, because that was already taxed money. But the moment I take out 1 cent of gains, if I withdraw the gains, the IRS wants the insurance company that I'm using, whoever that is, to withhold taxes on that withdrawal. So let's put numbers. 100,000 cost basis, 500,000 of cash value, just like the house idea. And I want to take 200 grand out. All right. Well, in the insurance policy, if I want to take 200,000 out, I put in 100,000. The first 100,000 I withdraw comes out tax free. If I withdraw the next 100,000, that's gains. If I withdraw specifically, and this is key to understand the verbiage, withdraw means the insurance company will have to hold taxes for the IRS. It would be the same idea as if I sold the house. If I sell the house and I make a profit as a single individual over $250,000 on the sale of my house, anything above 250 grand, I have to pay taxes on. If I'm a married person, right, that we both get $250,000 exclusion on our primary residence, so we can sell our house, make a $500,000 profit, not owe a dime in taxes. Anything above $500,000 profit on the sale of your primary residence, you're paying taxes on it. So if I withdraw my gains, I have to pay taxes on those gains. But if I borrow my gains, just like I'm borrowing equity for my house, I don't pay taxes. What am I paying? Interest. Yeah. So now when you go shopping around for a loan, what are you shopping around for? What are you looking for?
The best interest rate.
Yeah, the most competitive rate, right? The lowest rate that you can possibly qualify for. Okay. Life insurance is the same way. The challenge for a lot of people is that this mechanism, this provision, it's never been explained to them before. My dad was a CPA for nearly 50 years in Rockville Center. He didn't understand this. He hated life insurance salespeople. When I started learning about it, I'm like, hey, what do you know about Section 7702? He's like, huh? He was like 70 something at the time. And I remember emailing him a brochure that had been shown to me. I'm like, I didn't qualify for Roth IRA. I'm like, what do you mean I could do tax-free stuff? My dad's my accountant. He would have told me if I could. So I emailed him this brochure. It took him like 2 weeks to open up the attachment. He had no idea. I even had like turned the computer on. And he read it. And I fully expected him to call me back, and shoot holes in it. And when he called me back, he's like, this is probably a good idea for you. And it floored me, Paul, because I'm like, wait a second. How come you didn't do this? Like, tell me what. He didn't know, because every insurance person that he ever spoke to was a quoted sales agent who was trying to pressure him to A, buy something from them, and B, get his client book. They wanted him to be their guy. Like, send me all your stuff. You see the New York Life guys, the MetLife guys, all those old school insurance companies. So the mechanics behind this are just like borrowing from your house. Let's say you have that $500,000 in your insurance policy, whichever type, whole life, universal, whatever. And you put $100,000 in. That means you have $400,000 of gain. If you want to take $200,000 out and withdraw it, you're paying taxes on it. If you want to take out that $100,000 of gain, because remember, you could take the first $100,000 out that you put in your cost basis, you can take that out, no taxes. You can withdraw what you put in, no taxes. Once you reach gains, you can borrow them to be income tax free. So let's say now you go to the insurance company and you say, hey, there's $400,000 of cash sitting in your account, and I would like to borrow $100,000. The insurance company, whomever it is, says, Paula, absolutely. You have $400,000 of cash in this hand over here with us. We will cut you a check in the form of a loan for $100,000. So now you're going to have a loan of $100,000. Now, what they do, because the question naturally is going to come up, is like, well, how does this loan get paid back? Well, the $100,000 that they gave you as a loan is accounted for with $100,000 that's from the $400,000 of cash you have. What do they do with it? Of the $400,000, they take $100,000 and they put it aside into what's called a reserve account, a collateral account. And what that means is, just say you get the loan on a Monday and on Friday you pass away. You had a $100,000 loan outstanding. So they had a $100,000 loan in this hand, but they took from the $400,000 of gain that you had over here, they took $100,000 of it and parked $100,000 in collateral. So you died. The $100,000 loan gets paid off with the $100,000 held in collateral. You already got $100,000. There's $300,000 of cash left in your policy. So now the question then is, well, what if I did pay this loan back if I chose to? You don't have to, assuming the policy is structured the right way. You don't have to. But if you did, you know that insurance company isn't taking that collateral account and writing Paula on it and waiting for you to pay that loan back, right? No, they're putting it in their general account and they're going to earn some basic fixed rate of interest on it. So maybe they're earning 2% or crediting you 2% on that collateral account. Because if you did pay it back, you're like, look, man, I know you've been sitting on this thing. It's not collecting dust. You've been earning some type of scratch on it. Give me some of that, right? So they give you 2% on the collateral. Now they might charge you 2.25%, 2.5%, whatever it might be on the loan. And so what happens is your collateral account is earning 2%. Your loan is getting charged 2.25%, 2.5%, whatever it might be. And your net difference, your net interest rate might be 0.25%, 0.5%, something along those lines. Because you're getting charged interest on the loan, but the collateral that you gave the insurance company that they're holding is also earning interest. So they don't necessarily cancel out. It's not necessarily it doesn't wash away, right? But this is the mechanism by which people can fully fund insurance policies. This is not for everybody, but this is something that people who don't qualify for Roth IRA, people who have sizable incomes. We see this a lot in the executive suite and corporations. They offer that exact type of account to their highest paid employees as a perk. Because let's be real, in the high level corporate executive suites, it's very competitive. There's companies trying to poach and pull people from one company to the other. And so every company is offering things like 401k with a match, right? Stock options and all these other things. These types of plans, when structured the right way in the corporate world, they call them executive bonus plans. And what it means is that a person who's making a $400,000 or $500,000 a year salary, well, they can get a bonus, maybe 30, 40% of what their salary was, $150,000, $200,000, and have it be placed directly into this type of account, an insurance policy. And after it goes through taxes, because it's a payroll bonus, they have a $200,000 bonus. Maybe it means $150,000 actually drops into this policy. Now it's after tax money. So they already paid taxes and the seeds. And in many cases, the corporation who's offering this as a perk will create a vesting schedule. They'll say, hey, we'll do this for you, but you won't take ownership of this for 10 years. And what that creates is what's called golden handcuffs. Because now this employee is like, man, I'm getting a better offer down the street, or I don't really like what's going on here, but dang, I'm sitting on $1 million plus of cash inside of this insurance policy. And if I walk away, it's not mine. Right? So it's a way for that corporations, high-level corporations, for their highest paid employees. They've been using this as a means to keep their best people. One thing that's very interesting about that concept, let's say you own a company. If you open up a 401k, you have to offer it to your employees. These types of vehicles, executive bonus plans, don't have to be offered to everybody. You can select who receives it. It's like stock options. Not everybody's going to get stock options. All right. So it's a means, it's a tool for corporations to keep their best people. And for the people who are receiving this bonus, like, wow, this is great. I get income tax-free money later on. That's pretty cool. And again, if you borrow money, you're not paying taxes. You're paying interest. This is why we see the wealthiest people out there not paying income taxes, because they don't earn salaries. They have assets that have appreciated in value, and they borrow from a lender against that appreciation. And the money they receive as a loan is income tax free. They use it to fund their lifestyle. When it comes time for that loan to be due, they'll sell some of the stock or whatever it is. They'll pay capital gains on the sale of the stock, pay off the loan, and then do it all over again and avoid income taxes.
So they're really like their own bank in a sense.
As long as they have the asset, absolutely. You can, for the average person, who's like, man, I'm thinking about doing something like that. Well, this isn't for everybody, right? Just like hip replacements, knee replacements, that's not for everybody. Ozempic is not for everyone. Please hear me on that. That is not for everyone. Just like these types of vehicles, and this strategy is not for everybody, but it's doable if you've saved inside of it. There's a whole host of different benefits to using, as well as detriments to using permanent cash value insurance as a mean to accumulate tax-free money. But as long as there's money there, as long as you have an asset, you can borrow against it, and that's how you avoid income taxes.
Got it. And you mentioned something. You had said, as long as it's structured correctly. Could you give us just like maybe one or two things that we'd want to understand about, how these are structured, or what it means to be structured well?
Well, the first thing to understand, depending upon which kind of policy you have, whether it's whole life or whether it's universal, the IRS has created what's called a test, a life insurance test, to determine very simply if your policy is life insurance versus something called a modified endowment contract. Modified endowment contract means anything you take out of it while you're alive would be taxable. The death benefit to your family when you die would still be income tax free. Oh, by the way, all life insurance proceeds are income tax free to the beneficiary that inherits it. So when we say structured correctly, let's talk universal specifically. Universal is way more flexible than whole life. Whole life has a static set premium that you got to contribute for a certain amount of time. And they tend to have higher interest rates when you want to borrow against them. So it can be a little bit challenging to make those things last. Universal does offer some more flexibility. That doesn't mean it's better, right? But it does offer a little bit more flexibility. But that flexibility brings some challenges, because the amount of money I can contribute to my universal policy, the contribution limit each year, is going to be a reflection, a function, is determined by a few things. Number one, my age and my health. Number three, my age is one, my health is two. Number three is going to be the size of the coverage I'm getting. If I get a $100,000 death benefit, that's going to have a much smaller limit than if I got a $1 million death benefit. Now, some people might be like, man, let me get the bigger policy. Okay, well, there's going to be some drawbacks to that too. If I get a $1 million policy, that means I have a high annual contribution limit. That's typically called the guideline annual premium, or guideline level premium. That's usually what you'll read in your contract. That means I have a high, bigger face amount, bigger specified amount. That means typically I have a high maximum annual limit. But that also is going to mean I have a much higher minimum amount that needs to go into it too, which can present a challenge, right? So we want to structure it in such a way that a person is able to maximize the contribution that they're putting, meaning ideally we get the smallest amount of insurance coverage. If cash growth is their goal, smallest amount of insurance coverage that has the highest annual limit. That's being efficient. I will say, however, almost 20 years doing this, that's one of the things that I do and that I've learned to do, and I train people to help understand. All too often, however, we end up cleaning up the mess that quoted life insurance salespeople make. See, because what a lot of people don't understand is that the commissions paid by life insurers are typically a function of the size of the policy. And so if the size of the policy means bigger premiums. Bigger premiums means bigger commissions. That bigger doesn't always mean better when it comes to this. And so in a lot of cases, what I've seen and what we've seen is big death benefits with a very high guideline annual premium with very little money going into them. It's super inefficient because those policies have costs of insurance. They have fees associated with them, right? We can have another conversation about debating about whether or not those fees are worthwhile, worthy, legitimate, what have you. There's good and bad to all these different strategies that we have available to us. But when it comes to this, when we say structured the right way, it means it's been funded properly and we don't have too big of a policy with too little money going in. When we see that, it tends to be a commission grab on the part of a quoted sales agent who has to hit a number of sales by the end of the month, by the end of the quarter, or they risk losing their job. Another thing that we see, unfortunately, a lot is people owning multiple policies, none of which are maximum funded. And so now you see one, I just saw this with a gentleman who was he was 19 when he got his first one. Whether or not it was suitable, it was recommendable to him, debatable. Look, at the end of the day, it's life insurance and you don't know what's going to happen with your health. Most people think, oh, you're young, you don't need life insurance. Actually, the younger you are, the less expensive it's going to be. And you're able to lock in a health rating that's going to be there if it's permanent policy, like a universal or a whole even. It's going to be there for the rest of your life. You could end up with every disease known to man. But because you qualified when you were younger at a better rating, they're not going to change it. You got the rating that you got when you first approved. So there are reasons for younger people to get these things. In this case, he got one. It wasn't max funded. And 2 years later, he works at a pizzeria that his father owns, a family business. The agent came back. He works down the road from him here off of Veterans Highway in Long Island. And the guy comes back in, and the gentleman says, I'm thinking I want to save some more money. Well, the universal policy can be adjusted. It's called adjustable to allow him to do that if you want to save more money. But that's not what the agent did. They just you want to save more? Another policy. Quota. I got it. That's another quota. That's another sale for my quota this month. And he set the guy up with another policy, both of which were not funded properly. And so when the guy ends up sitting down with me and I opened up his policies, I'm like, yo, man, here's what's going on inside this thing. He's like, what? Pissed off. That's the kind of stuff. And this is true when it comes to life insurance, when it comes to your mutual funds, your brokerage accounts, you got a guy, all this stuff. See, people don't know what their blind spots are because this stuff has not been taught. And that's why when we say structured the right way, funded the right way, a lot of people are like, well, is mine structured properly? Is mine funded properly? And if you don't know, here's what ends up happening. An underfunded policy will end up lapsing. Now, why is that super important? Well, if your life insurance policy lapses, that means all the money you paid in is gone. And the coverage that your family expected to inherit when you died is also gone. The policy's lapsed. It's done. If that happens while you have a loan outstanding, remember, you took a loan because you want to avoid taxes on gains. Well, now that policy lapsed, the loan that you had is considered income to you. And now you owe taxes on it. Just like someone borrowing from their 401k, while they're working, that's fine. They don't have to pay any income taxes. Frankly, they're paying themselves back. That's debatable whether or not it's a right or a wrong idea, but fundamentally, they don't pay income taxes when they do a 401k loan. But they get fired. Now that 401k loan is considered an early withdrawal. They got to pay taxes and maybe even a penalty if they're under 59 and a half. The insurance policies operate the same way. If I lapse the policy because it wasn't structured properly, it wasn't funded right, or I didn't know what I was doing because the agent never helped me or service never helped me understand what was going on, and now I had a gain that I borrowed and the policy lapsed, I now owe taxes on the entirety of the gain. So go back to that example of $100,000 cost basis, $400,000 of gains. If I took $400,000 out in the form of a loan, policy lapsed, I now owe income taxes on that $400,000. So it's important that we say structured the right way, funded the right way, that a person actually has someone review their account and find out, is this really going to work? And for those of you guys watching and listening here, here's the piece of advice, an actionable item you can do right now. Call the 800 number on your insurance policy if you have a permanent policy, a whole life or universal, and ask them for an in-force illustration. And what that is, it's kind of like getting your blood work done. It shows you, here's your levels. right? All the things that you want to know when you do your blood panel. Now you have a baseline to compare against. An in-force illustration shows you where your policy is right now and what's likely to happen going forward. That is different than the one they gave you when you bought the policy. That was purely hypothetical. The in-force tells you what's actually happened in the 5, 10, 20 years that you owned it and what's likely to happen going forward. This way, we can get a better understanding of where you're at and what's likely to happen with it.
Really good advice. Thank you, Brian. I know this was a lot to digest, but I think even for me, I picked up on some stuff that even I wasn't, totally clear on. So I think that's really the goal of these conversations, is get people sort of, opening their ears and just listening to see and starting to ask the right questions, or at least start to do their due diligence on what they have or what they could potentially need. So
Yep.
Thank you for this, Brian.
You got it.